You are 22, you just started your first real job. The salary is $38,000, and after rent and loans and insurance and the half of your phone bill your parents stopped covering in May, there is no surplus. There is never surplus at 22. There is only the space between what you earn and what you owe, and the space is narrow and fills before you notice it was there. But something happens in your second month. Your last freelance check from college arrives the same day as your biweekly paycheck, and for exactly 1 week your checking account holds about $1,000 more than it is supposed to. One extra paycheck's worth of money. It is not savings. It is a timing accident, the overlap between a life that ended and a life that began. The money belongs to nothing, and nobody is expecting it. You could spend it, you almost do. A laptop that would make the evenings faster, a weekend trip that would make the weekdays easier, a jacket that costs more than a jacket should but not more than a jacket could. Instead, on a Tuesday evening, for reasons you will not remember by Thursday, you open a brokerage account on your phone, transfer the $1,000, the whole loose paycheck, and buy a total market index fund. The whole thing takes 9 minutes. You choose the fund with the lowest fee and the broadest exposure because those are the only two criteria you know, and you do not know them well. And then you forget. Not the dramatic kind of forgetting, the kind where someone opens a drawer 20 years later and gasps. The slow kind. The app moves to the second screen of your phone, then the third, then gets deleted when you need storage for photos. The password expires. The brokerage sends quarterly statements to an email address you check once a month and delete in batches. The $1,000 stops being a decision and becomes a fact buried in the geology of your 20s, beneath the lease and the job and the relationship, and the next job and the next apartment. At 25, the account holds $1,330. You do not know this. At 27, you get your first real raise. You do what everyone does with a raise at 27. You feel it. The apartment improves. The groceries get slightly more intentional. The breathing room widens and then fills because spending is a gas and gases fill their containers. The account holds $1,610. You do not know this either. At 30, you are cleaning old email and you find the brokerage confirmation from 8 years ago. You click the link, reset the password, and see the number, $2,140. $1 paycheck became $2,140 in 8 years without your help, without your attention, without a single decision after the first one. The return is 114%. You did not earn it. You did not monitor it. You did not sell when the market dropped 20% in year 3, and you did not buy more when it recovered in year 4, because you did not know either thing happened. You think about adding more money. You think about moving it into something a coworker mentioned last week, something that is supposed to double by spring. Then you close the app because you are running late, and the thought dissolves the same way the original deposit did, quietly, completely, without resistance. The password, once again, is not saved. At 32, the market drops 23% in 4 months. The news is loud. Coworkers sell. Articles with the word collapse appear on every homepage. Your checking account, the one you actually watch, stays flat because you do not own stocks in any account you remember. The brokerage account drops from $2,600 to $2,000. $600 disappear. The account does not send an alert because you turned off notifications in year 1 and forgot you did. The market drops, the account drops, and nobody is there to panic. Nobody sells. Nobody switches to cash. The absence of attention is not a strategy you chose. It is a strategy that chose you, and it holds. The market recovers over the next 14 months. By the time it does, the account has moved past its pre-crash level because the dividends that reinvested during the drop bought shares at the lowest prices the fund had seen in 3 years. The crash, which would have cost you $600 if you had sold, cost nothing. It accelerated the recovery. This is the first lesson of the forgotten paycheck. Crashes are only destructive when someone is watching. At 35, the account reads $3,450, $13 years. The original $1,000 has gained $2,450 in profit. You have done nothing. At 36, you decide to invest seriously. You open a second brokerage account with $3,000 from your tax refund. This time you're present. You read articles. You watch videos. You subscribe to a newsletter that sends daily stock picks. You buy individual names based on earnings, reports you mostly understand, and analyst ratings you entirely trust. You check the portfolio every morning before coffee. At 37, you sell a position that dropped 12% in 2 weeks. You buy one that rose 15% in the same period. The stock you sold recovers to its original price within a month. The stock you bought peaks the week after you buy it and declines for the rest of the quarter. This pattern has a name. It is called buying high and selling low. You do not call it that. You call it being responsive. At 38, a small correction arrives. 7% down. You sell everything in the active account. You move to cash. You wait for the bottom. The market recovers while you wait. You buy back in at a price 4% higher than the one you sold. The round trip cost you 11% and 4 months of compounding. At 40, the forgotten account reads $5,560, $18 years, untouched. The active account, which you funded with $3,000 and have added $2,000 to over 4 years, reads $4,100. $5,000 of active decisions produced $4,100. $1 paycheck of forgetting produced $5,560. You do not know this comparison because you do not know the first account still exists. At 42, the largest crash in a decade arrives. The market falls 31% over 8 months. Your active account drops from $5,800 to $4,200. You sell at month 5. You cannot watch it shrink any further. You move to cash and wait for the bottom, which you will not recognize until it is 2 months past. The forgotten account drops from $7,800 to $5,400. Nobody sells. The dividends reinvest at fire sale prices. The account buys more shares at the bottom than it has bought in any single year. 18 months later, the forgotten account is higher than it was before the crash. The crash accelerated it. This is the second lesson of the forgotten paycheck. The event that destroys active investors is the event that feeds passive ones, but only if no one is there to intervene. At 45, you are refinancing your mortgage. The bank asks for a complete list of financial accounts. You search your email for the word brokerage and find 2 results, the active account and a confirmation email from 23 years ago. You reset the password for the 3rd time in your life. The number reads $8,950. You open the active account beside it. After 9 years, 4 panic sells, 2 momentum chases, and $6,500 in total deposits, the active account reads $5,200. It is worth less than what you put in. 2 accounts, same market, same economy, same 23 years. The one you managed is down $1,300. The one you forgot is up $7,950. The only variable between them is you. You close the active account. You transfer the $5,200 into the same index fund you bought at 22, the one with the lowest fee and the broadest exposure. Then you delete the app. This time, you delete it on purpose. At 50, the original Paycheck's portion of the account reads $14,400, $28 years. It earned $1,350 last year on its own, more than the original deposit. The money now earns a copy of itself every year. The engine does not need fuel. It runs on its own exhaust. At 52, the number reads $17,400, $30 years. The account has survived 5 corrections, 2 crashes, and 3 decades of financial news telling you to do something with your money. The account's response to all of it was the same, nothing. And nothing was the correct answer every single time. At 55, the account reads $23,200. The original $1,000 has multiplied 23 times. The average annual return over 33 years was roughly 10%. 10% does not sound dramatic. It sounds like a savings account with ambition. But 10% compounded over 33 years is a 23x multiplier, and 23x is the distance between a Tuesday evening gesture and a number that changes how you think about money. At 58, the account reads $31,000. The last 3 years added more growth than the first 15. This is how compounding behaves at scale. The final decade does more work than the first 3 decades combined. The curve is not a line. It is a hockey stick, and you have just reached the blade. At 60, the account reads $37,400, $38 years. You have made exactly one financial decision with this money. Buy a total market index fund at 22 on a Tuesday evening in 9 minutes. One decision, 38 years of returns. And because you never sold, you never triggered a single capital gains tax. The gains compounded not only on themselves, but on the tax you never had to pay on them, money that, in an account someone was actively trading, would have been skimmed off and handed to the government year after year, instead of staying in the market and earning more. At 62, the account reads $45,000. You think about the active account sometimes. In 9 years of daily monitoring, you made hundreds of decisions, spent thousands of hours reading, and the net result was a loss of $1,300. In 40 years of forgetting, you made one decision, spent 9 minutes acting, and the result is $44,000 in profit. Per minute of effort, the forgotten paycheck earned roughly $4,900. Per minute of effort, the active one cost you money. At 65, the account reads $60,000, $1 paycheck, 43 years, $60,000. It is not retirement money, you know that. $60,000 does not fund a decade or replace a pension, but the paycheck was never a retirement plan. It was a seed. And the seed proved something that no article, no newsletter, no daily stock pick, and no amount of watching could prove, that the market, left completely alone, multiplies money. That the best thing you can do after investing is lose the password. That attention is not diligence. Attention is interference. In 2000, two finance professors, Brad Barber and Terence Odian, studied the real accounts of more than 60,000 households at a large brokerage. They sorted the households by one thing: how often they traded. The result was almost cruel in how clean it was. The households that traded the most earned about 11% a year. The market itself returned almost 18%. The busiest investors, the ones watching, reacting, adjusting, being responsive, underperformed the market by more than 6 points a year, every year, for no reason other than that they kept touching it. The paycheck you forgot at 22 was not smart money. It was untouched money. And untouched, it quietly beat almost everyone who was paying attention, for the exact reason their attention cost them. The absence of you was the presence of returns. You are 22 again. The brokerage app is open. The transfer field reads $1,000, $1 loose paycheck. It is not a lot of money. It will not change this year or the next. It will change a number on a screen 43 years from now, a number you will not expect because you will not remember the 9 minutes that created it. But the paycheck is not where this ends. It is where this begins. What does $200 a month become over 30 years? What does every raise become when you invest it instead of spending it? What does consistency become when it compounds for 4 decades? The answer is not a guess. The answer is math. And the math does not require your attention. It requires your absence. Set the transfer, close the app, lose the password. The market does not reward the people who watch it closest. It rewards the people who started and never stopped, and the people who started and forgot, and the people who trusted a Tuesday evening decision more than 43 years of noise. The paycheck was the proof. Everything after it is multiplication.